What's up, everyone? My name's Robbie. This is Robbie and Manila, and today we're talking about some of my favorite ETFs for a bear market. Okay, so look, the stock market, it's been absolutely crazy. This year has been probably one of the worst years. I think it's the second worst year on record for the first few months of the year. So there's all sorts of bad records that have been hit this year. So things are not looking that good. Of course, obviously, we know that this is what's going on. But what I want to talk about today is some potential ETFs that I kind of think could work well in a bear market. And what I need to do first, I think, is kind of define where we are right now and kind of how I'm positioning some of my ideas. And I just wanted to kind of give you some context about where I think there are opportunities still, even if the market's doing a lousy job lately. So yes, there have been good places to have some money, and it's kind of far and few between. One of those places was one of the things that I did discuss in my video about why I thought XLE was a good ETF to buy. And here's some information why. So year to date, so since the start of the year, 2022, the only sector that has had a positive return right now is the energy sector. So when I talked about XLE a few months ago, before kind of all this happened, in a way, it was a bit lucky because I wasn't thinking that the market was going to, I didn't think the NASDAQ was going to decline 25% in the first few months of the year. That was on my radar. I thought it was overvalued, but I didn't think exactly what happened was going to happen and as quickly as it did. So, I'm glad that I had a little bit of money put into XLE because the energy sector it's been the only sector that's done well this year so far. So the energy sector is up 26%. So there is some hope for people who have been invested in energy. And so, yeah, there are opportunities. Hence, energy was an okay place to have some money. Then you go to the next sector, and utilities is actually negative. So the next best sector is still a negative sector. So utilities, still you would have lost 2% if you had invested in utilities at the start of the year. But then we have to kind of talk about what is a good return right now. I consider it being relative performance. So if I'm talking about the S&P 500 and I'm trying to figure out what is going on and beat the S&P 500, what I'm looking for are just opportunities that are going to do better than the S&P 500. So if the S&P 500 is down 20% and I'm down 10%, I find that as a good opportunity for myself still. So that's how I kind of define it. And so what I'm looking at is, what do I think, let's say in the near term and then maybe a little bit out further than that, what are going to be decent sectors and decent parts of the market to invest in using ETFs. Now, if you'd gone back to my video at the start of the year, so you would have seen that I picked energy as one of my top sectors. I had 3 top sectors this year. So energy was one of them. I missed utilities. I didn't get that one right. I actually don't think I weighted utilities at all because I didn't expect such a bad bear market to start off the year. And I had consumer defensive on there, so consumer staples. Consumer defensive was one of my top ETFs. Then I had financials. So far, the ones that I thought were going to do the best are in the top few of the sectors. So I think so far I've been happy with my results. And the next question is, where do you go from here? So I'm talking sectors today. I'm also talking market caps. Another thing, let's talk about market caps real quick. So now if we talk about year-to-date performance in terms of market capitalization, so how big these companies are, we take a look here. We say, okay, large cap companies, some of the larger companies in the US, were down 16.89%. So it's been better to invest in large companies than mega cap companies, just by a little bit, right? So not by a lot, but mid, small, nano are all kind of down there together in the negative 22%. So you can look at this a few different ways. You could say, well, large caps have been more resilient because they're down less. Okay, possible. You could also look at it and say, well, large caps are not down enough, right? So maybe you think large caps are going to catch up to mid or small cap stocks. So there's that potential. The generals, as they say, are starting to fall. So the bigger companies, the companies that have been more resilient over, for this whole time when there's been this bear market kind of bleeding out a bit, the Googles and the Amazons are now starting to fall. And so is that going to continue to bring down some of these stocks and generally the S&P 500 with it, right? This is from Charlie Bolello on Twitter. So look at these growth stocks. So these are like high growth boom stocks. The year 2000 is the green, right? These are the green stocks here. The returns of these stocks since 2000. These are the current returns from 2021, 2022. Oh my God, look how bad these are. So NEO's was up 1,112%, down 72%, right? And so you just look through these, and these are the companies that I don't think I want exposure to right now. So when I go to look at ETFs, I'm looking for things that are going to avoid basically these types of stocks for now. And then if we go over here and we take a look at what's going on with just growth versus value, we can see the Russell 2000, like I was talking about before, is down the most. Again, it's a growth, so these are small cap growth. The Russell 1000 growth is also in top worst, right? So it's not until you get to the value that you see the better returns, so not down as much essentially. So the Russell 1000, so the let's say large/mid cap companies are down 6.3%, but they're up over the past month so far to date. So this is what I'm kind of saying, is that I think these values plays are probably going to do okay for the next, let's say, few months to a year. I think the growth plays are not going to do very well. And so when I'm talking about ETFs and which ones I like, I'm avoiding certain ones, and I'm going to be talking about the ones I like, meaning that they're probably going to be more value-oriented or into sectors that I kind of like. All right, so let's go ahead. Let's figure out some of my favorite ETFs here. Now, this is not a list of my favorite ETFs. This right here is something I'm going to compare some things to, and I'm going to remove the ones that I don't think are necessarily going to be that great for the year. So let's start with XLE. XLE is an interesting one. I talked about XLE. I had a video on XLE. It was my top energy ETF. I made a whole video on why I was investing in it. And I'm happy that I added money to XLE because it's up 35% this year, right? So what I don't know, and what I'm kind of I haven't made a decision on yet, is right now if XLE is still a good ETF to invest in. So maybe I'll make a video on that once I kind of determine what I think. So for now, XLE is on my maybe radar. Then we get down here and we see some of what I think is pretty interesting. So let's not look at VDC yet. I'm going to talk about that in a sec. So SPYD is a mid-cap dividend ETF. Now, something I really like right now is the idea of dividend yielding ETFs, because I think they're going to be more resilient this year. So in a downturn like this, in a bear market, yield is something that a lot of people are looking for, and companies that are paying decent yields oftentimes, let's say if they're in the S&P 500, for example, which SPYD only invests in S&P 500 companies, then you're probably going to find some decent stocks in there. It's not investing in like small cap stocks paying high yields, right? So these are bigger companies, they're paying yields, and it's an ETF that's actually up almost 2% in a giant bear market. So very impressed with how this has held up so far. And so for me, this would be an ETF I would be interested in this bear market. Now for VDC, I'm going to come back to this one, so we're going to skip that for a sec. So SCHD is the Charles Schwab US Dividend Equity ETF. And so SCHD and also VYM are two of these different types of kind of S&P 500 larger company with higher yielding stocks in it. So I like yield right now. So ETFs that have decent yields are going to probably be ETFs I'm going to be interested in right now. So SCHD is going to be on there. SPYV, so now you can see SPYV, you compare SPYV to SPYD, the dividend yielding ETF, doing better than the S&P 500 value ETF, right? So the S&P 500 value ETF, it's doing fine in what's relatively going on with the S&P 500, but it's still down 7.6%, but still value outperforming growth, as we can see here. So SPYG, the spider growth ETF, getting annihilated, right? So down 23%. So look at the difference here, and that's what I'm talking about. Right now you're being rewarded for not investing in growth and investing more in value and getting more yield. This is all the stocks in the S&P 500. So this is why I don't like SPYG right now, and I'm just not happy or not looking to get into a growth stock right now or growth ETF right now because of what's going on growth-wise in the market. I think it's going to be a little bit of time until growth comes back. So over to VDC. So VDC is a sectoral type of play here. So a sector of the stock market. So the consumer staples sector, or the consumer defensive sector, you might call it, right? So these are companies that are like selling staples, right? So if you go to the supermarket and you buy bread, you buy tuna fish, you buy the things that you're gonna like need on a daily basis that you're not gonna give up during a recession, that's this. This is not like luxury goods, Louis Vuitton, right? This is things that you need that you will probably always buy during bad times and good times, right? So this, I think, will tend to outperform in a time like this. So that's something I might have some exposure to. And then along the lines of having some type of sector plays, utilities would be in here. So actually I need to add the utilities real quick. So this is VPU. So this was actually my top pick for a utility ETF. VPU is down just 0.27% for the year. So again, a decently yielding ETF. Wait, let's take a look at the yield on VPU real quick. So here we have VPUs actually yielding 2.83%. So you're definitely getting some yield. And also SPYD, let's talk about the yield real quick there for SPYD. So for SPYD, you can see that there is a higher yield than the utility ETF, 3.79%, the SEC yield, so the 30-day SEC yield. So yeah, this is a great yielding ETF as well. So here you go. These are some of the ETFs I kind of like right now. So I just kept SPY in here to just show you relatively what's going on. So SPYV, SCHD, VDC, VPU, SPYD, XLE, I think are all decent ETFs right now. Now, last thing I want to talk about real quick is time frame, basically time horizon. If your time horizon is really like 5-10 years down the road, then having these more defensive ETFs, I don't know if those are going to do better over the next 5 years. I would try to probably assume they may not do as good on a total return basis over that time period. Now, growth I think will come back at some point, right? So if you bought growth now and you wanted to hold it for 5 to 10 years, I think you'll probably be rewarded. But if you're looking more of like how much you want in different parts of your asset allocation right now, do you want to add a little bit of money into utilities, add a little bit of money into these other maybe more defensive sectors that might do well in recessionary or bear market time periods? That's what I'm talking about here. So just for example, we're zoomed in. This is SPY, right? So S&P 500 ETF, we're zoomed in, down 14%. But whenever you look back into long periods of time, SPY is going to always do well, up 82%. So when you look back, at some point you say, well, what do I care if it was down at this point in time? Like here you would have said, oh my God, it was down like 30-40% in this area, right, when COVID started. And maybe you're doing the same thing here. I don't know. I'm not trying to like make a prediction on how fast this comes up or when this comes up. It's more of like I want some exposure to defensive parts of my portfolio for now. And then maybe over time, maybe over the next like 12 months, I rotate out of some of those defensive things. Or as I put more money in, I don't put them into the defensive things. I put them more into maybe the more growth things that I'm going to be looking at. Anyway, ETFs are a portion of my portfolio. About 35% of my portfolio is individual stocks. I put about 25% of my portfolio into just a what I call value momentum strategy, which is a stock screener video I made. You can watch that. Then the rest is like ETFs and buying ETFs on the sector, recreating the S&P 500 sectors, right? So not all my money would go into these different things, but it's a strategy and it's part of my portfolio, and I want sections of these ETFs probably in certain sections of my portfolio. I hope that makes sense. So anyway, thank you for watching this. Let me know if you want to see more videos about maybe like what's going on with the bear market or maybe market updates or something like that. If you want that, let me know, and please watch another one of my videos coming up right now.